Hey everybody, hey traders, Chris over here. This is a video for my Trading 101 playlist. I've had this request coming up the last couple of weeks in my Discord channel. Obviously, I'm posting a lot of stuff on just trade results on my blog through the week. That I've got some Forex trades, got some stocks and options trades, some crypto, all that good stuff. So more and more interest being generated. I trade a lot of options during the week, and so look, I think that options come with a whole slew of knowledge, and the learning curve can be really intimidating. The language, the vocabulary, what each option strategy represents, all that stuff I want to kind of, debunk right away in this kind of intro video for everything options. So the best way to start is first by talking about this. This is one of my least favorite displays of what option trading looks like. Basically, you have the profit on the vertical axis. So right here, okay, this is going to be your profit, the up and down, y-axis, and then it's the underlying stock price. So if the stock price is going up, it's to the right, and if your profit is going up, it's up here. All right, so that's what they mean when you see these like profitability curves and how this all plays out with options. What's dumb is you look at this inherently and intuitively, you're like, what does this mean? What am I doing with the option? Where's my break even price? So I just want to put all that to rest, and let's not even worry about this. I can explain this if you want to, take a screenshot of this, and as I go through today's video, maybe you can break this down and you can say, oh, that makes sense. And now, there's a reason of what the x-axis is, what the y-axis is, and how it all makes sense. But for me, I like to keep it way simpler. Okay, so I think a good place to start is I'm just going to walk through. This is one of the courses that I have for Market Traders Institute. It's called Delta Trader. And what we do in this class is we essentially trade day to day, week to week. We trade a lot of the SPY, we trade the SPX, we trade the XSP, we trade the QQQ, we can trade individual stocks around earnings. Basically, it's short term options trading. And, initially when I first launched this course, the idea was to focus on 0 days to expiration, a lot of the single day expirations. There is a time and a place for that. I still love single day expirations if I feel confident we're going to have a good flow of the day. My least favorite thing is to sit in front of your charts and computer every day at 9:30's opening bell and think, I've got a place to trade today. Because my job is to be profitable. And not every day is it a great day to trade. There are some days where the SPY, for example, might only move $2. And if I have an options trade that gives me $1 strikes, I'm barely going to carve out any profit on the day. And then other days, the SPY might move $6, $7, $8. Well, that's a lot easier to pay, a dollar for an option and see it go $4, $5, $6 in profit. So there's a time and a place, like I said, for 0 DTE. What I like to do is trade for the week and focus around my week. And then if I find a good day and a good vibe, a good flow, good technicals on the day, then I'll look to buy a low. Then I'll look to sell a high and try to get some decent trades for those single day expirations. So for today's video, it's, like I said, options 101. So I'm going to give you kind of my core option strategies and just give you the terms, the pros and cons, what it means when I trade this strategy, what price has to do, how you can generate profit. Because if you take this video and think about it this way, if I trade this strategy, what does price have to do? Now you know enough to consider, if I need price to go up, this is an option strategy I can take. If I need price to go down, this is an option strategy I can take. If I think that price is going to be sideways, here's an option strategy I can take. Fair enough? So I hope that's enough to equip you with a couple of different option strategies to go to. And again, trying to take out all the silly jargon and all the vocabulary and all the funky graphs, and let's just get to the bottom of it, okay? So if I go to this right here, I'll minimize this. Let's start with long calls, long puts, credit spreads, which is a bull put spread, bear call spread. Again, let's not worry about the names, but these are the ones that I'm going to go through, and I'm just going to take a screenshot of this so I don't have to keep referring back to this. Let me take a screenshot of this right here. And in today's video, this is going to be my focus. So a long call, long put, bull put, bear call, credit spread repair, covered call strategy. And I'll even throw in a bonus one for you today. And we're going to do a straddle as well as a strangle. So again, stupid names. Don't worry about the names. I just want you to focus on what each one does. Now, what's nice is I'm going to take a screenshot here. I'm going to add in a little bit of extra space. I'll do and we incorporate this quite a bit, a long strangle and a long straddle. Okay, So let's make these a little bit smaller. Take this down to like a 14, move this up here. There we go. So now I can fit this in. So in today's video, again, it's going to be pretty quick. It's going to be a general overview, but I'm going to break down each individual strategy to tell you this is what I do, this is what it means. If I take this trade, is it a debit or a credit? What does price have to do? And how do we generate profit? Okay, so let's start out with the first one. First one is going to be the long call strategy. Long call strategy is this. It's a debit trade, which means I will pay the broker for this trade. I expect in a long call strategy the price of the underlying option to go up. Okay, so as an example, let's say that I trade Apple and Apple's trading. So Apple price is $150 per share. Okay, an Apple $150 call option is trading for, let's say, a $2 debit. This is what it means. If I buy a $150 call option, let's say that I go out for a 1 week expiration. Okay, so let's say it's Monday and I buy this $150 call option for $2. So execute the trade, right? It's a $2 debit, which for one contract is going to cost me $200. That's going to be my max risk. So the nice thing about a long call option is I know that my risk is defined. I can lose no more than what my maximum payment is on the option. Okay? So if I pay $2 for that option contract, it controls 100 shares. So it's $2 for the debit times one contract is 100 shares. So it's $200 max risk. Now, if Apple goes, let's say Monday to Friday, from $150 to $155, all right, then my option contract, realistically, my option contract should be $3 credit or better. And I want to tell you how I get that math. I'm doing the 150 call option, but I paid $2 for it. So technically my break even is going to be $152. Now, if price by closing bell Friday, if I have a Friday expiration, if price is trading at 155, that means that I have legitimately $3 of actual value in that trade. So if I paid $2 and by Friday near closing bell is trading for $3, what's my net profit? My net profit would be the $3 value of the option contract minus the $2 debit. It's a $1 credit. And I'll put net credit, right? And so that's going to be $100 profit. Okay. Now here's the good thing. Now you're looking at that like, well, I mean, I have $200 of risk. I'm only making $100 in profit. That's true. It's not exactly a high reward to risk. But let's say that Apple, same situation. Let's say Apple for $150 by Friday is trading at $160, right? Now, my $150 long call for $2 is now worth at least $8 profit because I pay $2 for the 150. That gets my break even to 152. The price of the underlying assets trading at 160, which means I have $8 of real intrinsic value in that call option. Now, if this happened by like Tuesday or Wednesday and I still have time left, I might have extra profit on top of that. But just going from the simple math, you can calculate all this stuff ahead of time with these option strategies. Now, full disclosure, I'm going a little bit longer on this first example because when I do a put strategy and it's just a long put, it's the same thing in reverse. All right. You want the direction to go down. So a long call strategy, you want the price to go higher to make money. A call option, a long call option is a bullish strategy. You want the price of the asset to go up. Okay. So what's nice about this is if I do a long call, there is unlimited upside. If you have a crazy, ridiculous move to the upside, that's all value that you get on top of what you paid for it. So if I paid $2 and all of a sudden it's worth $8, well, that's a huge difference, right? Now all of a sudden I have a huge net profit, right? I paid $2, I'm seeing this trading for $8, I have a huge profit on the trade. That's awesome. So now I get the 3x return, now I get the 4x return, and I'm much happier being a long call option trader. Does that make sense? So long call, just in summary, it's bullish. You want the underlying asset price to go up, and you want it to go up before your expiration. And whatever is up prior to expiration, you have a real intrinsic value to that option contract, and hopefully it's enough to cover your debit and give you some net profit. Okay? That's a single direction. It's defined risk. The most you can risk on a long call option is what you paid for the trade. And believe me, I've had plenty of trades where I do a long call and I make $0, right? I might get like of a $2 debit, I might get 5 or 10 cents back by the end of the week, which sucks. Or I might just let it expire worthless and I get $0 and I risk that entire amount. So there's risk, but it's defined. I can't lose more than what I paid for the option. The upside is if you have a huge move in your favor, it is all profit potential to the upside if this underlying asset goes up. Okay? So asset prices here, if I did an at the money, which is a fancy word for saying if price is 150, at the money is $150 call option. If the price of the asset goes up, I can make money. That's what I need it to do, right? Pretty simple. Now let's just flip it around and go for the long put. If this is Apple at $150 and I believe Apple's going to go down, I'll do the same thing here and just reverse it. So now Apple is $150 per share, and I buy the $150 long put for $2 debit. Okay? I need Apple price to fall for this option to be profitable, right? That's what I need it to do. So if Apple's price drops down, let's say to 145, let's say it drops down to 140. Let's see if we can do the math on this, all right? So if it drops to 145, or it drops down here to 140, again, this is all happening within the expiration. So if I went 1 week out, so today's Monday, if I went out to Friday's expiration and I bought a 150 long put for $2, and by Friday the price is trading at 145, that means that we've had a $5 move in the stock price, but because I paid $2 for the debit, my break even would be 148. Right? My break even is 148, which means if price is trading at 145, I can see that this is now trading for a roughly $3 net profit. Okay? So 148, the price is trading at 145. I can get out of this trade for probably $3 net profit. Okay? And if it goes all the way down to 140, that's a $10 move in the asset, and I paid $2 for it, I can walk away with roughly an $8 net profit. So this would be roughly a $3 net profit, and this would be roughly an $8 net profit. So the $3 net profit is around a 50% return on the position, and the $8 net profit is a massive gain of nearly 400%. All right. Now, what else do I calculate and factor in with stuff like this? What's the weekly trading range? What's the daily trading range? Do we have earnings? Is there a catalyst? What's the current environment? All these stuff matter when it comes to just trading in general, let alone when you're pricing out options. But again, very simple, very basic. Tons of traders will just trade a long call or trade a long put, and that's fine. It's very simple. You have the defined risk. You can't risk or lose more than what you paid for the option contract. The upside of the profit is unlimited, but you obviously need price to go in your direction. So a long call, you need price to go up. A long put, you need price to go down. Okay? So how about this? For the sake of time, I'm going to wrap up this video. I'm just going to call this one Options 101, long call, long put, and I'll just put this video up on my YouTube channel. And I'm going to work on another video, and it's going to be the same concept, and I'll just follow along with this list. The next one is going to be this: bull put and bear call spreads. So it's a very basic, very common. I use it a ton in my trading room, a credit spread video. And then after that, I'll go into the other ones. I'll talk about repairing the credit spreads, covered calls when you own stocks, and then some bonus strategies here. So look for a video 2, look for a video 3. This is going to be Options Trading 101, all part of my YouTube playlist, Trading 101. And again, if you haven't subscribed to the channel, you're checking out this video for the first time, I've got tons of content. My Trading 101 video series is like 60 plus videos. I'm live every week on Mondays and Fridays. Like, subscribe, all that fun stuff. Follow along. You can also join my Discord channel, which the server name is Chris Pulver Trading, and you can check that out. I have a link also in my chat. You can join me for a live session, and I post that live every single Monday and Friday when I'm live on my YouTube session. So I'll see you in the next video. We're going to talk more about credit spreads. Okay, see you soon.